Hi, thanks for your question about whether it's worthwhile to borrow to fund concessional contributions into super. I guess the first thing we need to acknowledge is that if you do borrow to make superannuation contributions, almost always that is not a tax deductible expense. The only way you can get it to be a tax deductible expense is if it's a business expense for you. So that is if you're self-employed, or for example, a self-employed person might employ their spouse and make superannuation contributions on their behalf. And if they do that, the business does that, you might be able to argue it's tax deductible. But for most of us, concessional contributions, borrowing to make concessional contributions is not a tax deductible exercise. So therefore, it just becomes a comparison between the tax benefits and the after-tax interest cost. So the tax benefits of making concessional contributions are the difference between your top marginal rate and the rate at which they're taxed inside super. And so if your adjustable taxable income is less than 250,000, you're going to pay 15% in super. If you're paying 47%, for example, so you earn this year more than $180,000 or 190 next year in 24-25, then your tax benefit is 32%. 47 minus 15. It's a pretty substantial tax benefit. If your adjusted taxable income is greater than 250,000, then your contributions are going to be taxed at 30%, and so your tax benefit is 17%. Still not bad, depending on the quantum of contributions you're making. So that's your tax benefits. That's how to work out your tax benefit. Then you've got to think about what is your interest cost. And that's going to depend on how long it's going to take you to repay that loan. So, for example, if I had to borrow to make concessional contributions and the tax benefits were substantial, but I thought I could repay that loan within the next 6 months, it's probably going to be worthwhile to do that. But if it's going to take you several years to repay that loan, it's probably unlikely. The other thing to think about, which you can't really quantify necessarily, is you're moving money into an environment that is ultimately in the future going to be tax-free. So not only do you get to invest those monies and only pay 15% tax or 10% on capital gains between now and retirement, but when you're in retirement, any investment earnings on that capital will be tax-free. So that's pretty attractive to do. A pretty attractive, I think, part of super, of course. And one of the benefits of getting or making more concessional contributions, but a bit difficult to quantify. I think it really comes down to, are the tax benefits substantial? If so, can we repay the loan pretty quickly and therefore minimise interest? If you can answer yes to both those questions, you'd probably do it. If you can't, then you probably wouldn't. Thanks for the question. I hope that answer is helpful. Cheers.